Welcome to the Economist in Your Ear podcast. Can policies that, on the surface, seem to actively work against electric vehicles actually end up helping them in the long run? It sounds incredibly counterintuitive, doesn't it? But that's precisely the provocative question we're investigating today as we unravel the recent, seismic shifts in U.S. policy regarding electric vehicles.
Absolutely. It's a truly fascinating and complex picture, one where the immediate impacts don't always align with the potential long-term consequences. The key insight we'll try to uncover today is whether this immediate relief for automakers truly translates into a faster, more robust electric future, or, perhaps even slows it down.
Right.
We're going to unpack the current landscape for automakers in the U.S. and see if we can understand the real forces shaping the future of electric mobility, not just the headlines.
Okay, so let's pull back the curtain on a surprising take from a recent piece in The Economist. It bravely suggests that these policy shifts, widely labeled as anti-EV, might actually be a hidden catalyst for Detroit's big three car makers in their electric transition. It's a bold claim, isn't it? Implying a kind of strategic benefit hidden in what, for many, looks like a significant step backward for electrification.
It is bold. And to understand this, we really need to trace the path of several impactful policy changes that have sort of reshaped the playing field for automakers. Imagine a series of legislative dominoes falling. First, there was the One Big Beautiful Bill, signed back on July 4th, 2025.
Okay.
This bill made a crucial change by effectively eliminating fines for car makers failing to meet federal corporate average fuel economy, or CAFE standards.
The CAFE standards, those efficiency rules.
Exactly. They're designed to improve vehicle efficiency, and by reducing the fines to zero, a key lever nudging manufacturers toward EVs was essentially neutered. And what else? We also saw the nullification of California's Clean Air Act waiver, which allowed tougher state-level emissions regulations.
Right. The California rules, always stricter.
Though that particular move is currently tied up in court, so its final impact is still uncertain.
Got it.
Looking ahead, federal EV purchase credits, the ones that could offer you up to $7,500 for a new vehicle, they're set to disappear on September 30, 2025. There are some limited binding contract grace mechanics, but basically that incentive is going away.
Okay, so the consumer incentive is vanishing too.
Pretty much. And finally, there's this proposal to rescind the EPA's 2009 endangerment finding.
The Obama-era one.
That's the one. It determined greenhouse gases pose a threat to public health. If that's successful, it would essentially end all federal emission standards, though, again, legal challenges are widely expected there too.
Wow.
And, one more crucial piece. The new 25% tariff applying to imported vehicles and many parts, that significantly complicates costs for the Detroit Three. Can't forget that.
Right, the tariffs add another layer entirely. So these are undeniably moves that lessen the regulatory pressure on automakers to produce EVs, creating a much more relaxed environment for them.
Considering these significant policy shifts, how are Detroit's automakers actually reacting on the ground? What tangible evidence are we seeing?
You've hit the nail on the head. Detroit's immediate reactions certainly seem to reflect this, at least in the short term. We've seen GM announce a substantial $4 billion investment plan, specifically to shift production back towards those incredibly lucrative pickups and SUVs with petrol engines.
Big profitable ones.
Exactly. They're adding capacity for models like the Silverado and Sierra and shuffling Escalade production around. And Stellantis, well, they're not being subtle. They're literally bringing back their Hemi V8 engine for the 2026 Ram 1500.
The Hemi V8. Wow. That's a statement.
It really is. That's not just a product launch. It's a clear symbol and signal of continued reliance on internal combustion, a powerful statement that they're leveraging this newfound regulatory breathing room. Precisely. So the economist's core argument, then, is that by watering down these rules, lessening the burden, the president is actually doing Detroit a favor.
That's the crux of it. It allows them to sell more petrol cars, which, as we said, currently offers significantly healthier profit margins than EVs do. The underlying idea, the theory, is that these fatter profits from gas cars could then be funneled right back into EV development.
Okay.
Essentially kickstarting the transition from the inside, funding it themselves rather than being, dragged along by government mandates.
Right.
An investment bank, Jefferies, even went so far as to posit a credible scenario for 2026 where the benefits from looser emission rules would actually outweigh the burden of these new tariffs.
Outweigh the tariffs. That's interesting. It's a very specific corporate finance perspective focusing on that immediate bottom line.
It is.
Okay, so on the surface, That narrative of profits funding the future certainly has a compelling ring to it. It paints a picture where less pressure now means more investment later. But when we look closer, what does the reality check tell us about this dynamic? Are the benefits truly outweighing the costs? And for whom in the broader picture?
Well, the cash flow math for Detroit can indeed look favorable in the near term, just as The Economist suggests. With those CAFE fines reduced to zero and fewer purchase credits needed from other automakers, like Tesla, compliance costs definitely decrease.
Okay.
And this does significantly impact companies like Tesla, for instance. They made, $2.76 billion selling regulatory credits in 2024?
A huge amount.
Yeah, a huge amount. And that revenue stream is now clearly sliding in 2025. So for legacy automakers, this immediate financial relief on compliance is undeniable. It frees up capital.
Makes sense. It makes their balance sheets look healthier short term.
Exactly.
But you mentioned tariffs earlier as a major counterweight. How heavy is that counterweight, really, when we look at the raw numbers? Does it challenge this immediate relief?
Absolutely. Street estimates put the 2025 tariff drag for Detroit in the multi-billion-dollar range. We're talking serious money here.
Billions. Okay.
So while some analyses, like that Jeffries one, argue that real relief could eventually exceed the tariff hit, that's highly contingent on how much tariff relief actually materializes and how these costs balance out over time. It's certainly not a guaranteed net positive.
Right. Lots of if there.
Lots of ifs. But what's even more crucial to understand, I think, when we look beyond corporate balance sheets, is the impact on actual EV adoption. Bloomberg NEF, a leading research group, has significantly revised its projections downwards.
Okay, what are they saying now?
They now see U.S. passenger EV sales rising from around 1.6 million in 2025 to 4.1 million in 2030.
That still sounds like growth.
It is growth, of course, but it represents only a 27% market share by 2030, and their previous forecast was 48%.
Wow, 48 down to 27. That's a huge drop.
It's a dramatic drop. This isn't just a pause in growth. It's a meaningful drag on the overall transition to electric vehicles in the U.S. It's actively slowing down the market.
This meaningful drag on adoption really makes you question the whole friend of EVs framing that the Economist article puts forward, doesn't it? Where does that narrative start to, unravel when we consider the broader implications and the actual pace of this transition?
It raises a really important question. Does making it easier to sell gas cars truly accelerate EV development in the long run? Is that how it works? What's fascinating here is that policy whiplash, these rapid, sometimes contradictory shifts in regulatory priorities, can actually raise significant capital expenditure risks for automakers.
CapEx risks, okay. How so?
Well, softened standards and vanished credits create a shallower and inherently more volatile U.S. demand for EVs. The market becomes less predictable. So what happens then is that companies factor in higher discount rates on their big EV projects because the future market is less certain.
That makes sense from a finance perspective.
Right. And this, crucially, can delay the learning curve cost drops. Those cost reductions that come from scale and experience, they get pushed back. And those are absolutely essential for making EVs truly competitive and affordable for the mass market.
So the uncertainty slows down the cost reduction needed for EVs to take off.
Exactly. And Bloomberg NEF, for example, they didn't just cut their long-term outlook, they cut both their near and long-term U.S. EV outlooks in 2025. This directly contradicts the idea that these policies are some kind of long-term boon for electrification. In fact, it points to significant uncertainty and a slower path.
So it's not just about immediate profits then. It's really about the broader investment climate, long-term planning, and the confidence to commit billions to future EV production in what needs to be a stable, predictable market.
It almost sounds like Detroit is being given a strategic reprieve, maybe a chance to rebuild the war chest with gas car profits. But in such a rapidly evolving industry, can you truly afford to hit pause, even for a moment? That's the key question. And if we connect this to the bigger picture, global competition is forcing the issue anyway, regardless of these domestic policy shifts.
Right. The U.S. isn't an island.
Not at all. U.S. automakers don't just sell at home. They operate in global markets where emissions rules continue to tighten and EV adoption is often much more aggressive.
Like Europe or China?
Exactly. Think about Ford's announcement of an affordable $30,000 midsize electric pickup slated for 2027. That's a big deal. And GM's plan to add lower-cost LFP cells in Tennessee by 2027 with LG Energy Solution. LFP, lithium iron phosphate, that's a battery chemistry known for lower cost and better durability.
Cheaper batteries, affordable models?
Yes. These are prime examples. These cost-down EV plays are born out of global market pressures and the need to compete internationally. They aren't necessarily a direct result of domestic deregulation. They would likely be happening anyway because the global market demands it. The race for affordable EVs is well and truly on worldwide.
Okay. And the idea that those newfound ICE profits will just neatly fund EV development. Is that as straightforward as it sounds? Does the money just flow seamlessly from one vision to the other without hitches? Or are there hidden complexities there too?
Not entirely straightforward, no. While Detroit can certainly self-fund from robust ICE margins, that's true. But facing a smaller overall EV market in the U.S. because of these policy shifts, that actually creates significant utilization risk for their new battery and assembly assets.
Utilization risk, meaning the factories might sit idle?
Potentially, yeah, or run below capacity. Those expensive new factories built for EVs might not run at full capacity if U.S. demand is dampened. And that makes each EV more expensive to produce because you don't get those economies of scale.
Oh, okay. So lower demand hurts the cost structure.
Precisely. And unless exports or localization abroad can fully fill that gap, the very same tariffs, the ones supposedly offset by looser rules, actually complicate those international hedges.
So the tariffs make it harder to sell those EVs elsewhere if the U.S. market is slow.
Exactly. It makes it harder for automakers to manage risk and scale up their EV production globally to compensate for softer domestic demand. So the picture is much more complex than just a simple cash flow transfer from gas cars to EVs.
Okay, let's try and unpack this for you, our listener. We've got a really complex situation here. Detroit automakers are experiencing some immediate financial relief from relaxed regulations and credit changes. That seems clear. But we're also seeing a significant slowdown in projected EV adoption for the U.S. market.
Yeah.
So what does this all really mean for Detroit and the future of electrification in America when you factor in both the good and the drag?
Yeah, if we connect this to the bigger picture, the net assessment is definitely nuanced. It's not black and white. In the 2025-2027 timeframe, Detroit automakers will likely see benefits to their earnings from looser regulations and credit relief, even with the tariffs factored in.
Okay.
So The Economist's short-run corporate finance logic, looking at that immediate bottom line, it actually checks out in a way. However, and this is a critical distinction, for electric vehicles themselves, this very same policy mix slows U.S. uptake significantly. And it raises planning risk for automakers who are trying to make these huge, long-term, multi-billion-dollar investments in batteries and new platforms.
It's a powerful distinction. Short-term corporate benefits versus a potential drag on the actual EV adoption curve.
So, looking further down the road, what's the biggest strategic headache this unique U.S. policy mix creates for American automakers trying to compete not just domestically but also globally in this EV race?
I think the biggest headache is simply the uncertainty. It fragments their strategic focus. While they might get a domestic reprieve on emissions, maybe make some more money on trucks for a bit, the global markets are accelerating towards EVs.
So they risk falling behind globally.
Potentially, yes.
Mhm.
The long-run competitiveness of EVs for the big three will ultimately come less from any Washington tailwinds, helpful policies, and much more from their fundamental ability to industrialize cheap batteries like those LFP and the slightly more energy-dense LMR chemistries, lithium manganese rich, right, the technology itself.
And ship truly compelling, affordable products. Cars people actually want to buy in that $25,000 to $35,000 sweet spot. And crucially, they need to do so on time. It's about fundamental engineering, supply chains, and market execution in a global race, not just navigating domestic regulatory breathing room.
It really makes you wonder, doesn't it? If the drive for innovation and cost reduction in EVs is truly a global race, one driven by worldwide competition and consumer demand for affordability, does that mean domestic policy is increasingly playing a secondary, perhaps even counterproductive role in shaping the future of our roads here in America?
It's a compelling thought. Perhaps the biggest impact of these policies isn't to fundamentally alter the final destination, which seems to be electrification, but maybe just to change the pace and critically raise the cost of the journey for everyone involved, automakers, consumers, everyone.
A more expensive, perhaps slower journey. Food for thought. Thanks for listening. Follow us to stay updated with the latest insights on The Economist every day, and don't forget to like, comment, and share.